afternoon, everyone, and welcome to Stock Market Today. It's Alissa Coram and Mike Webster back and better than ever on this Friday, May 17th. Yeah, this is the best take. We're coming at you, and we're taking names, taking tickers, and going to have a lot of fun today. We've got some market analysis for you, stock analysis, and historical analysis. Webby, great to see you.
Yeah, it's nice to be back. Sorry, I had technical issues, user error on my end. I had YouTube open at the same time, and that didn't work out. So I lived and I learned. I did a post analysis, shut some stuff down. I'm back.
Yeah, we're back and better than ever. All right, and I'll be monitoring the comments in the Q&A. So thank you all for submitting your comments. We have some fun ideas for what we want to do with our live viewers on YouTube and those who comment, but more on that later. Let's get down to business. A lot to get to today. So we're going to take a look at the major indexes. We've also got some Nvidia, CrowdStrike, and GDX analysis. And as I mentioned, a little historical analysis like we like to do. So let's first take a look at the major indexes today. The NASDAQ down less than 0.1%. The S&P 500 up 0.1% on the day. The Dow was up 0.3%, and the Russell 2000 just ever so slightly lower on the day. So Webby, please kick us off with your high-level market thoughts.
Well, you really couldn't ask for more than what we got this week. I mean, everything that we wanted to have happen happened. It's actually good that we paused the last couple of days, because what you don't want is a stock market to get too hot too quickly.
Right.
That creates more problems on when it comes back down, and we'll actually see an historical example of that later today. So stick around for that towards the end of the show. But this is exactly what we want to see, and we're going to get into it later. But a power trend, unless we fall apart on Monday or Tuesday, will be starting on early next week. And so we'll get into what a power trend is, what that means, what it doesn't mean.
Why it matters.
Essentially, it's a very good thing.
It is. And yeah, there's ways to position yourself in the market when we're in a power trend. So really good things to know, especially with Nvidia earnings around the corner. We've got to be aware of that as well. Okay, so any other thoughts on the NASDAQ, the S&P 500? I mean, I guess the significant high-level headline this week is we're back in new high ground.
Yeah, let's pull up the spiders real quick.
Sure.
On a daily. And when you get close to an old high, that becomes a battleground for bears and the bulls, right? So you've got all the people that want it to go higher and the people that want it to go lower, and they're fighting. And we know what side won this week. The bulls clearly won, because if you're a bear, meaning you're short the market, not a bear that you're just negative, but bear that you've got big money at stake. We're talking big hedge funds. They're out there with, billions and billions, tens and hundreds of billions of dollars at work. And if you are short, you're trying to use all your ammo right as it's at those highs, because you don't want what happened this week. So meaning pushing above that, because the definition of an uptrend is higher highs and higher lows, right? So we were able to form a higher high this week. So now we are clearly, by all definitions, in an uptrend. And so that puts the bears on the ropes, and they'll try the best they can to mess things up. So be ready whenever you get any negative news at all, either from if Nvidia comes out with anything disappointing, if we get anything from the Fed, any economic numbers, they'll try to push that down and make it look as ugly as possible in the short term. But right now we've got this trend behind us. And so that's when you want to take the opportunity that as things are coming in, if you get upside reversals or they come into logical areas, that's where you want to increase exposure. So it's completely different than 3, 4, 5 weeks ago when we were underneath the 50, underneath the 21 day. That's
Mhm.
when you had to play defense. Now we're playing offense, and it's a completely different game. It's more fun, but you cannot be reckless. You've got to do it in a methodical, um, methodical way, and we'll talk about that throughout the show.
Yes, we will. Okay, now let's pivot to a couple of stocks on our radar. And let's start with Nvidia. A lot of focus here because of earnings next week. And you and I both own this one. But this is going to be very pivotal for the market, for the AI theme, for the chip sector. So, and we don't know what's going to happen. All we know is that expectations are high.
Yeah. So as we go into this big earnings announcement, and what people need to realize is there is this thing called Regulation FD that happened a while back. You can Google it if you want. It doesn't really matter. It's just basically when that happened, um, it changed everything as far as technical analysis going into earnings. And what it meant is the companies now cannot do a wink and a nod to big mutual fund and hedge fund managers or analysts of what their earnings are going to be or might be. And that's what used to happen. So as you would go into an earnings announcement like Nvidia that we have next week, that with it shaping up like this near all-time highs, if all the big money folks, the boys and girls out there they're controlling the market, if they knew what the real numbers for Nvidia were, they would be making the chart look like this. And that's how it was from the 1880s until about 20 years ago. Then things changed, and the government said, "Hey, all this information has to be released to everyone at the same time. It's fair, right?" But what happens is then you get these big moves every quarter, and you can see it on any stock now versus historically, where you get gap ups of 5, 10, 15, 20% or more. Same thing on the downside.
Right.
That's in the cards for next week. It's in the cards for every earnings. What does that mean? What do? What you do is you don't increase your exposure to that area right now. If you've got some lower cost basis positions or some small positions with just a little bit of a gain, you might sit through those into the Nvidia numbers. But I would not be increasing your exposure into chips or AI related things
Right.
too much ahead of that, because it is a crapshoot. But this is looking good. Of course, the standard pivot is the 974, but it's already really broken out of this little handle in this cup with handle. I know it's showing up as a consolidation with pattern rec, but that was your breakout. And so it broke out. It's pulled out back in gently into the pivot. That's a very normal action, but you just want to make sure that you don't have too much of it because of the risk event next week.
And then I think taking this one step further is, okay, so let's assume folks out there like us own it, have some profit cushion, or maybe you don't. And maybe there's not enough time at this point to get that profit cushion. What do you do if there's a favorable reaction if you own this or have been watching this stock? And then also, what do you do if you own this and we get an unfavorable reaction?
Well, that's a great question. And it's the initial reaction and the final reaction that you want to be aware of, because you could have an initial reaction that's positive where it gaps up. And then it's like just like what happened that
Right.
last time where it hit the 974.
Or even CrowdStrike.
Or even CrowdStrike
Yeah.
that's a classic example. So it's not how it opens, it's how it closes. And you see go back to the CrowdStrike because that's
Sure.
great.
Yeah.
That when you have something like that, then you want to back away. It doesn't mean that you have to blow out your entire position, but if you get a gap up that reverses like that on the numbers, it doesn't matter what the numbers are. If you knew what the numbers are right now, if you had that inside information, it really wouldn't give you the edge right now because you don't know how the street is going to react to it next week. So if you get something like that, then you're paring back your position, because what is it? Doesn't mean the stock is over. It just has to base out like CrowdStrike has, and I have a position in this one as well. And so this is now based out. So let's go back to the Nvidia for a second. So if that happens, or like what we had the downside reversal back there at 974, you reduce your position. What I would prefer to have happen is kind of a weak open, but on decent numbers that then builds throughout the day. And so if you got a test down to the 50-day with an upside reversal, and an upside reversal is simply the opposite of what we saw there at 974. That was a downside reversal. Downside reversal, big spread closing at your lows, essentially. There's some more to it, but that's really what it is. Upside reversal, just flip that. A big spread closing at the highs. That would be the ideal thing. That's why you don't want to go into it too heavy, because then you might be forced to reduce that exposure in the morning and then have to buy it back later. But that happens all the time. So in a nutshell, I wouldn't go too heavy in it unless you have low cost basis stock. I don't have low cost basis, so mine's pretty high. So I'm going to have to be careful. I might even have to back away prior to the earnings. And it really depends on the rest of your portfolio. If you're heavy in this space, you want to look at all your chip stocks and just say, you know what, maybe I have just too many chips and I'm going to switch over to software or home builders or restaurants or something else for the meantime until we can get through this.
Right. Makes sense. Okay. Well, we mentioned CrowdStrike. So let's go there. Another nice performer this week, up almost 8% on the week.
Yeah, and I really like the the action in this, and we have both of these on Swing Trader. What's good about this is, let's pull up the IGV, which is the software, just like SMH is the chip ETF. The IGV is for software, and this one has been base building for quite some time. It's been out of favor, and lots of times the market will just do rotations in bull markets where one sector will set out for a while another one kind of comes on. So while we've seen the software space sit out since February, other things like restaurants for sure have come on, and some of the chips have still been doing well, and some other random things here and there. So now that we've kind of sat out for a decent period of time, this was able to get back through the 50-day. I think that's very positive for the software space, and it gives you a chance to diversify. Even though most of the software is touching directly or indirectly to AI,
right?
At least it's somewhat diversified from just the chip space. So let's go back to the CrowdStrike itself and go out to the monthly, if you don't mind.
Yep.
And with this, when you look at a monthly, you can see that this stock has had the ability to have a really nice run before. And that's something that Bill O'Neill, the founder of IBD, would always, talk to me about, of when we would look at a stock together every Sunday night that we did for 15 years. We'd spend hour and a half together on the phone going through things for the list that we managed together for the institutional side. When we would go over a stock, the first thing we do would be analyze the monthly. And you want to see something like this where it's had a prior big move. And he would be fine even if the prior move was a decade or 2 decades ago. He wanted to make sure it was something that has been able to have a big move in the past. Doesn't mean it'll do it again, but right now it's looking that way. Let's go over to the weekly for a moment. And this is, more of an institutional quality stock than a lot of things that we might just trade for a swing trade. And yes, the earnings line, the stability there, that's something that institutions love because it's predictable. And so if you're an institution, you're not holding for a few days or a few weeks or even a few months. They're holding for, a year, 3 years, 5 years, even longer. So the more stable the earnings are and the faster they are, like this is super fast, growing at 100% a quarter for 3 quarters in a row. That is unheard of. I mean, that's so rare. So that's a high quality stock. Now the base, we're not going to get into all of it right now. We have on IBD Live, and who should be watching IBD Live every day?
Everyone,
and their brother and their sister and their mother and their cat, and certainly their dogs should be tuning in because we go over things.
We've had some. We've had some pets watch IBD Live. We've had some, or in this show, some kids So hello to
Yeah.
kids out there who watch this.
Bob Furman used to have his grandkids watch the show, and it's a fun thing. It's a fun show for families. Please tune in together, or if you can't watch it live, watch it later in the day. It's just packed full of information, and we've gone over this space. Now let's go on a week by week basis. Let's go to the daily to see kind of the action plan. So this is a cup right now without handle, and I would say that it really already broke out 2 days ago. On that day, where the real pivot felt like those highs 2 days after the 365, that little downside reversal there, that really feels like the resistance. I know the resistance was the top at 365, but this just feels like it just broke out, like it's not too late, too early, kind of Goldilocks just right. That RS line is nicely back above its moving averages. So I think this is still actionable. Of course, I do have a position in it. I tend to have tight stops. So if it doesn't act well, I'll be right out of it. Certainly, I'm not going to let it come all the way into the 21-day, which is that green line there.
Yeah. Okay. And we also want to talk about GDX because we saw gold on the move today, gold miners. So this is a gold miner ETF. We saw silver on the move and crypto. So this is a good one to discuss, up 3.4% today and breaking out of a very long base.
Yeah, so this is something that we did have on Swing Trader. We reduced it just to put it in to use that capital in some other stocks, but we want to get back in this space because it does look like it wants to make a good move. Pull up GLD, which is the gold ETF, and go out to a monthly chart. And this is something that our good friend Jim Ropel has been talking about for a long time, how long that base is. So there's people out there who love gold, people who are out there who hate gold. Just kind of be neutral on it and just say, what is the chart doing? The chart hasn't done anything for a long time. It's formed this long base, and now it's starting to break out. So you're trying to get some exposure to that space. Now let's talk a little over to the GDX on there, which is the gold miner ETF that we're talking about. And you can see the difference between the two. So over the longer period of time, gold has done better than the gold miners. So the gold miners are more of a trading type of vehicle, right, whereas gold is more something like a preservation of capital type of trade, kind of like the crypto space. But that's a topic for another day. Let's go to the daily. And so this just broke out of that cup with handle. It's only 3% from its pivot. Can you show them where they see that, the 3% in the top right corner?
Yep.
Yeah. So that's the power of using the pattern rec, that these little bells and whistles will really help you, even if you don't have trouble seeing the patterns within market surge. This is something that it took me about a decade to develop and is in there. I hope everyone uses it. There's lots of bells and whistles. Please watch some of the webinars and podcasts that we have on, related to pattern rec and how to use it, and reach out to the customer service folks, great folks at Market Surge that are really there, and they want to help you with, all this, what everything means. But this is only 3% out, so I think it's still actionable from a position trade, from a swing trade. You want to try to stay within 2% of a pivot, and right there, that's your kind of alternative pivot that you would want to get into it there. And this is, today would have been where you would have been adding to that. So right, within a handle, that downtrend is an excellent place to get it. And also point to the very bottom of that handle, that upside reversal.
Yep.
That's an excellent place to start a position as well, because with an upside reversal, I think I said downside. With an upside reversal, you use the low of that as your stop. So you could have been initiating a position there, or wish I had, and then you could have been adding to it as it broke those downtrends there, which there were several of them, and then adding to them just here recently.
Great walkthrough there, Webby. Thank you so much. Okay. Now we are going to take a look at some other charts from Webby's screens, and we're going to take a weekly view at the S&P 500 and NASDAQ. So we're going to go there first. So over to you, Webby.
Okay, let me know when you can see my weekly SPY.
Yep, we've got it.
Okay, perfect. So we're doing the Bob Weir, take a step back and looking at it on a weekly. You can also look at it on a monthly. And what we have here, we're going over this every week, where this was our old regression line, starting at the bottom there in November and working its way up. It broke out of that. We talked about that a lot on this show. And now it's bounced back. So this is just, you always want to look at the weekly to kind of have the bigger picture in mind. And let's look over at the composite in the same picture there on a weekly basis. We're in fresh new highs, and we're just looking for this new trend to continue. And so that's about all we have on the weekly right now.
Now let's take a look at our retracement levels from the highs cleared after the three waves. Oh, wait, you did want to take a look at the daily regression lines. I'm sorry about that.
Oh, no worries. So yeah, here is the daily regression. Here's those three waves down that we had. One wave, two waves, three waves. And then up here, we kind of paused and then had this new regression start, and then it broke out of there. And last week we talked about how we were starting this this one here, this new regression channel, which you really want to have about 50 days or so, which we don't have, 50-point data points for your regression. But we started it here, and now we've brought this out to today. That's our starting and our end point. And for those of you who are into this type of thing, this is, I use lots of ways to use regression. And close your ears if this stuff is bothers you. +1 plus -1 standard deviation using a high plus low divided by 2. Don't worry about anything that I just said. All it means is a trend. That we're just trying to define a trend. Then it's from here to here, and we want to see if we're within that, and more importantly, how steep it is. So now it's still a little on the steep side, but it's not unrealistically steep for at least the first part of the move. And again, I'm starting this off on 426 and I'm ending it here. And let's look at it, the same thing for the NASDAQ. And again, I'll blow this back out so you can kind of see the old trend, and that was at a nice angle. And you can see this is a little too steep still. So we're going to blow this up, and we're just paying attention to, is it staying within this? Because you're always asking yourself, is something normal or abnormal? And so the wiggles and wobbles that you have within the day, really, if those bother you, then kind of step back, look at this daily chart with these regressions on there and see, is it really made a material difference? And you can see that it hasn't. It's just all hanging in there tightly with this relatively short period of time for a regression.
Yeah. Okay, so that's it with the regressions. Now we're going to provide some retracement updates.
Yeah, so we're not going to go over this other than to say this was the old retracement that we were doing from the old highs in July up to the highs here on April 1st. And now we're back through that. So no reason. We're going to put this one to bed and not revisit it going forward. But what we are going to do is look at a shorter time. So this was that same time frame from there to there. Now we're just going to look at it. And let me blow this up. This is the spiders. And I'm starting this off on our first follow-through day in spirit, meaning it qualified as a follow-through day on a price basis and in a position basis, but the volume wasn't higher than the prior day. So it wasn't an official follow-through. So we're going to start off our low there, and then we're going to do the high to the high from yesterday. And the importance here is just, are we staying in the top part of that if we pull back? So you always want to plan for a pullback because things don't go straight up. You don't want them to go straight up. They go up, they come down. They go up, they come down. And you want kind of 2 steps up, 1 step back, 2 steps up, 1 step back. So this is 2 steps up, 1 step back would be down to this 50% retracement which is 518.61. And so as long as it stays above that, you're staying bullish. If it starts trading below that, then you're starting to kind of look out.
Great.
And
Okay.
we'll do the same thing just on the composite
Mm-hmm.
on the NASDAQ, starting on the same day, 426, going to yesterday's high. And the exact same thing there, 16,284. And what's nice is that coincides with the 21-day, something we'll be talking about in a little bit.
Quick question for you, Webby. Do you view these 50% retracements as more significant than, say, pulling down to a prior high? Or I guess that's where our levels will come in when we look at the levels.
Great question. So I look at it in two different ways. And let's just toggle over to the levels. So just let me go to SPY, because we're going to do SPY on both first. And keep in mind that 518.61. I'm going to jot that down because
518.61.
I'm old now. I used to be a youngin', but I'm old, and so I can forget stuff.
518.61.
Okay. So here are our levels on SPY. So 518.61 is right around in here. So there's not really a level besides the 21-day there that the rest of the market is going to be looking at. And what you want to think of is when you're looking at levels, levels are places where the stock or an index should get support because other people are seeing that. Whereas a 50% retracement, that's an art. And if we toggle back to like where I started my 50% retracement was on this day, on the 426, no one else out there is going to be doing that. They would have been starting it down here at this low. That would have been a logical area to start it. And so that would have put your 50% retracement at 512.69. That's where the general public that uses 50% retracements would do it. But again, like I said, it was an art. So we're going to toggle back to our levels and see that 512 is kind of, that's in that area, which is right underneath the 50-day. So that becomes an important level. So that's a long way of saying that when it's something that everyone is looking at, like a 200-day, a 50-day, to a lesser extent, a 21-day, or some key levels of support that everyone sees, you want to pay attention to the action in one way. And then you want to be really paying attention to the intraday action, because that's where the bulls and bears are fighting it out. These other levels that I'll mention, like a 50% retracement, it's giving you a sense of, is it acting right or not in general? And it's okay if it passes through it a little bit or doesn't even come down to it, because it's a squishy level that's an art. So there's an art and a science. These levels here are more of a science. 50% retracement is more of an art. Does that make sense?
Yeah, we love using art and science in what we do. So
perfect. Okay, so I'm going to blow this up a little bit more so we can focus in on these key levels.
Perfect.
We're going to start at the bottom and work our way up. So we do not want it to come through this low, the solid line. That's our recent low from 419. So that if it got down there, then man, we're probably going into a serious correction. The next low is the low here on the 5.2, and that was kind of its pull back after we had this follow through day in spirit, kind of came down to the 5.1 and 5.2 area, so just underneath 500. So also round numbers are important. That would be 5,000 on the S&P 500, but we're looking at the ETF. And then over here, the low from the this 5.3, which was a key gap up day that we had, very powerful follow through day in spirit. And so you don't want it to close below that. You don't even really want it to trade below that level. And of course, those are below our 21-day and our 50. Now we move up to more recent, action. This is the old highs over here, the 524 and change. That could easily test. If it tests that, no big deal. You just want it to come back from it. It would be normal, healthy, and logical for the market to come down there. Do we want it to? No, because we're probably all deep in the market, but you want to know what would be normal. So a pullback to 524, especially if it had an upside reversal in there and you're light in the market, that would be
Mhm.
where you would want to add exposure. And then I
Yeah.
always keep a green line at our recent
Highs.
highs. Now we can toggle over to the NASDAQ. We'll just be brief on this. Same thing, same basic levels. Again, the one that you'd be focusing in on is kind of this level, which is your old high from 321. So that's 16,538. So a test of that would be normal, which kind of puts you at the low of the 515. They're about the same area. So kind of expect that. Know how your portfolio would probably act there, just
Mhm.
so you're not too top heavy.
Great. Okay, so now we are going to take a look at the 21 EMA to put things into perspective.
Okay. So I know I might have lost some people, especially if you're newer to trading or you don't use regressions and all these levels and stuff. And that's fine. That's totally fine. And I understand that. On the most basic level, if you don't do anything else that we talk about, just look at the 21 day. I've removed everything else from this chart except for the 21 day. I prefer the exponential because that moves a little bit faster. That all the exponential versus simple just means is exponential puts more weight on the
Mhm.
most recent time. Simple is it spreads it out equally over the time frame, over 21 days in this case. So as long as we stay above that, especially our low above that, all is good, and you're leaning bullish, you're leaning up, being aggressive. And let's look at the Nasdaq. Same thing here. And even though our candles that we had the last couple days, people would look at that and say, okay, you have two pink candles in a row, which are meaning that you open stronger than you close. That is fine right now because it's all in context. You had
Right,
these two big up days,
right.
and you expect to have some reaction back. And if you go back to one of our old homework assignments, was the Jesse Livermore book, How to Trade in Stocks, came out in 1940, I think. That is, the foundation of a lot of Bill's work, a lot of what IBD does, and he talks about that of your natural reactions, and he has some different terminology. So move from here, your natural reaction, you expect it to come in to about here and then move higher.
Great. Okay, so that's the 21 day, and we looked at SPY and comp, right? So
Yes, we
now
did.
I think
I'm
we're
gonna
ready to transition over to our Webb RSI. So we're going to get that pulled up because I think as this new uptrend progresses and we have that 21 day line very much in focus, we want to be taking a look at the trading view of the Webb RSI. So we're going to go there, and we have some special research we're going to show you shortly. But here's a look at the Webb RSI, and so we'll focus in on the bottom. And as we talked about last week, Webby, when you have these new uptrends beginning, you want to see a lot of power.
Exactly. So the Webb RSI, this for anyone following along at home, this is my second version, and I've coined it the Webb RSI version 5.150, and that is where I've changed things from percents to ATRs, and we'll probably talk about ATRs maybe on a separate podcast or webinar someday in more depth. But all it is the average movement. That's just how
Yeah.
much what's normal. And over here, we have these in terms of this is one ATR, so it means one normal movement. This two normal movements. Three, that's when it's getting a little too hot. So, and all this is your low versus your 21 day exponential moving average. When it's blue, and that's what you want to focus on, the blue histogram down here, and it's in the sweet spot is typically between about a half an ATR to about two ATRs, and that is your normal like safe zone where you're still expanding your exposure, you're increasing your exposure in the market. When you have a turn in the market like we had recently, you want to see this power. You want to see it get up to even 3, sometimes even more than 3 ATRs versus your 21 day, because that's showing that the bulls are really in control. It's bringing the market up, and then it can settle down and kind of just trend nicely. So
Yeah.
we're not going to get hung up on the other stuff on here. That's for another day. So right now, this is acting perfectly. Now let's toggle over to
The
what the
comp. Yeah.
NASDAQ composite looks like. And same thing there. It's acting perfectly. So as long as we're in this type of position where our low is above our 21 day and it's staying in this general area or expanding, we are leaning very bullish and looking to kind of move from more of the slower names to a little bit of the faster names. But of course, we're always going to be aware of things like the Nvidia earnings that we talked about earlier.
Exactly. Okay, now we want to take a look at your off high indicator to add a little bit of color there. And since we're in new highs this week, we're not off the highs all too much, are we?
Yeah, and there's just a little bit of a rounding thing that we need to fix up. This is still my beta version in here, but essentially, and this is what I like to say is my parents have now, they're big fans of you. They watch you on Fox
Aw.
Business all the time when you're on, and now they watch this show every week. And they forced my daughter, my 22-year-old daughter, to watch this last time, and her reaction, the sweetheart, she said, "Oh, Dad, I really like your Bob Marley indicator."
Oh, there you
So
go.
she's not into
Yeah.
trading at all. So now I just need to get her twin, my son, to maybe have to watch it this weekend. So, anyways, the point is, this is a family show. Please watch it with all of your family. And so, again, let's just talk about what this Bob Marley indicator is. And this is just your ATRs versus your high. When you're in the green zone, that's good. When you're in yellow, cautionary, red, you look out below. Green is just 4 ATRs. Yellow is 4 to 8 ATRs. So we're back up here. So all is good. We don't need to belabor that too much. And then the same thing with the NASDAQ. So that means as long as we stay in this green area, and we'll just bring this up every week, that you're keeping on the gas. Doesn't mean you don't tap on the brakes every now and then, but in general, when you're in the green area, you're on the gas. When you're in the yellow area, you're putting on those brakes. In the red zone, it's time to go on a vacation and build a watch list.
So there's one more thing that you can do though with the gas pedal though, and that's coast. So is that when you're seeing it's still in the green, but it coming down?
Exactly. So notice in here where it's coming in here, right? But is staying within the green area, because look, it's unrealistic for something to be pinned at its highs and never come down.
Right.
So you want it to come down because that's a corrective phase, because just like what we were talking about, you don't want it to overheat. So you want it to vacillate in that green zone. And then what you want to do is see where the natural time that it pulled back, because there's nothing magical about 4 ATRs off of its high. It kind of works out nicely, but really it's where has it trended below. And so when you're looking at this trend that we had from October up to March, it was pretty much staying in this kind of 1 to 2 ATRs off its high. Over here kind of got to 3. So at that point, when it comes down to 3, you're expecting it to turn and bounce, and that's what that did. And so I'm not one of those buy the dip type of traders, but those who do buy the dip, that's when you're 2 to 3 ATRs off. That's when you're looking to do that. The way I do buy the dip is when you're coming down there and you have something like this, that upside reversal. There's a beautiful upside reversal, right? And let me bring this down a little bit here on February 21st, that you can go back and study, where it came in, undercut its 21 day, and then closed back up at its highs. And down in the Bob Marley off high indicator, it came down perfectly. It didn't undercut its prior low, which was on January 5th. So that was when you want to gas it. And then your easy exit would have been, hey, any trades that you put on there, if it undercut that, you back out of those.
Perfect. Awesome stuff. Okay, now we are going to talk about some historical analysis. You and Justin always have something up your sleeve, Webby. So, because we are on the verge of a new official power trend starting early next week, which we will do the full definition and all that, what the audience is seeing now is some dates of past power trends. Just give us some additional context here before we take a look at one of these examples.
Okay, and while we're bringing this up, because I can't see it yet, but what a power trend is, just so for folks who want to know what it is something that Charles Harris, Justin, and myself came up with as part of market school, and that's something we developed back in 2011, and it was really to figure out how Bill's mind thought, but in black and white, because we knew, that Bill wasn't always going to be there to tell us what to do or to guide us. So we wanted something that was black and white. And so we came up with all these rules. There's a home study on it that's available on investors.com. If you're into that, I'm very proud of the work that the three of us did. Suggest you get that. One of the important parts was this power trend, because we noticed that at times Bill would say, hey, 5 days of distribution, you got to get out of the market. Other times it would be 8 days of distribution and he still had the gas pedal on. So we kind of reverse engineered and we said, you know what, when you get these big moves up, that's when Bill is acting differently. And so we then just completely 100% original research dialed in to like trends and where could we get in as early as possible. And we came up with this power trend, which is a big part of market school. It's very, very, very simple. So it starts when
power trend is market school, not so much.
Well, market school, yeah, it's not really simple. But each element is simple, but putting it all together is not simple.
No, but it's great. It's great. I love it.
It is great.
But the power trend is what we're going to be focusing on today. So let's define it first.
So a power trend is simple. It is with first thing, your 50-day moving average has to be in an uptrend. Okay. Next, your low has to be above your 21-day exponential for at least 10 days. And then the one thing that we're waiting to have happen, and that is our 21-day to be above our 50-day for at least 5 days in a row. So, and then there's one final thing that we always put in there that we only took actions on up days.
On an up day, yeah.
Yeah, because that was a nod to Bill, because he would only do things on positive days. He would increase exposure. So we thought it was kind of silly, turn on this power trend on a down day. That's not something he would do. He did not use power trends. He didn't need it. He didn't need power school. He was Bill.
Yeah, he had he had it all built in up here. So that's why one of the reasons why you set out to do it was to systematically
to come up with something to like create a black and white version of Bill's mind. So that's the power trend. Again, you started on an up day. You have your 50-day and an uptrend. You have your 21-day, your low above your 21-day exponential for at least 10 days. And then your 21 days above your 50-day for at least 5 days. And that should happen on Monday if we have an up day and we don't go and take out the 21-day, which would make for a really bad day if that happened. Do we have that? I don't see the slide.
So you're not going to see it in our interface because it was uploaded differently. This is how the sausage is made, folks. We got this data a little bit last minute, so I didn't get to make it look quite as pretty as I like to do. But and your connection's lagging just a little bit, Webby. But I did send you the Excel file. It's going to be on the second tab, and that's what the audience is seeing if you want to follow along there. But basically,
I can open so I don't crash the show again. Within this little thing over here, I can do this, or should I go to my email to look at it?
Yeah, you can do it in that little chat. That'll be fine. Yeah.
All right. I'm going to go there because, boy, I do not want to
have a repeat of
it's telling me to request access. So I'll just go to his email. So why don't you talk through while I get that up?
Yeah. Okay, I'm granting you access now. This is how the sausage is made, everyone. So
It's
we
kind of like I feel like I'm on Saturday Night Live. I've got
yeah,
it now.
you
So,
know,
I always wanted to be on Saturday. No, I didn't because I'm not funny. So, what we are looking at, and I'll just kind of go over it since this is relatively new to you since you saw like 10
yeah,
minutes before the thing
yeah,
started. So, we have in history of the NASDAQ, there are 87 power trends. What we're seeing here is a subset of those power trends. These are the ones that turned on back on within 25 days of an old power trend turning off.
yeah,
Because remember, we had a power trend that just turned off recently, and on Monday it would be 23 days from that power trend ending. Um, and so I said to Justin, I'm like, hey, let's just look at the power trends that turned back on relatively soon after an old one
mhm,
turned off. And so this is our sample size. So we have 16 of them, and the length ranges from as short as 7 days to as long
mhm.
as 301 days. And
And
the
you can blow
average,
that up again, Lily. You can blow that up again. Sorry, Webby. Go
sure.
ahead.
And the max length is 301, and these are all trading days, not calendar days. And so what you're seeing there in orange is typically when a power trend ends, it's simple. The 21 day just crosses back through your 50-day, that ends it. In market school, lots of times we're already out of the market. We're very light by the time that happens. So it's not like when you go to study these, this is your homework. It's not like you're waiting till that end day before you exit. That's just when the power trend turns off.
Officially, yeah.
The the ones in yellow, that's when we have this circuit breaker. And we thought, you know what, we wanted to build something that was, if the market were to crash, you don't want to wait and say, oh, power trend is still on. But, we had a 1987 crash or 1929 crash or the flash crash. We didn't want
Mhm.
that. So we said, okay, if the market comes down more than 10% from its recent peak and it goes underneath the 50-day, then the power trend is off because that shouldn't happen. So those are the examples. And in 1999, I had a couple of those. Those were extremely volatile. The flash crash, that's the 2010. And then the only other one that we have here in this sample set is the one that happened in 2021. So again, please go back and study these. We will put these in the show notes. Allie and I will also tweet these out on X because I want you to study these over the weekend. The length and the distance from the last power trend. So,
Mhm.
with all that said, what did I leave out, Allie?
Ooh, you didn't leave out anything. We're going to be taking a look at an example. And I think just for additional context, the why here. Okay, why are we doing this? Well, we want to see if there can be a potential roadmap for what to expect in our current market situation. That's what why we're always studying history, to give us that little bit of edge of what if something similar happens that happened in the past, as one potential scenario that could unfold, right?
Exactly. And so I'm glad you brought that up because Bill, everything that Bill O'Neill did was based on precedent analysis. When he came up with all the information for his book, How to Make Money in Stocks, it was all based on our models that we had developed, that he developed, and then I had the pleasure of building for about 20 years. And we learned everything from those of just studying the biggest winners in history. And we do the same thing with the stock market itself, within on an index level, because we're using the roadmap from history to guide us. It doesn't mean it's going to be exactly the same, but you have history to guide you, and that's what we're about ready to go down this
Yeah.
fun journey of a change date. Right?
Yes, we are. So we're going back to market surge. The first change date for those playing along at home is 11/29/2016. And yeah, this does look somewhat similar to what we just experienced.
Yes. So this is in that little Excel file that we had there, where the one that turned on 11/29. So when you're doing your homework this weekend, which I know who is going to be doing it,
Everyone.
everyone. Yes. um, And so this is when the power trend turned back on. So it's important when you're looking at precedent analysis, you always want to look at what it looks like at the beginning, because what happens is if you just look at it afterwards, everything gets compressed and it looks like, oh, it's obvious. But
Yeah.
imagine this is all the information you had at the time. This was going into that big election back in 16. You had those, big bad days down in a row. Election results came out. The market liked it. Doesn't matter about your politics. We do not talk politics here. The market liked the reaction, moved up, and started this very, very long power trend. And this is what it looked like at the beginning. So this is similar to where we would be on Monday. The day before this is similar to the day before this, so the 28th. So just do a change date to the 28th. Just go back one day.
Okay.
Just for fun. So
it's all for fun.
It's all fun. So this is where we are right now, possibly, right? Where we're on a down day. We went up. We're down. We're almost at what would qualify as a power trend. Now let's go out to the end of that year, to end of 2017, to see what it looked like. And then could you mark on there where we were with this one?
Yeah, let me do that.
So that was November 29th.
Do I need to zoom? There we go. Need to zoom out just a little bit more. So there we go. There's where we were.
So that's a beautiful thing, right? So such a really tight action, nice power trend. Now, that's about as good as a power trend is ever going to get. It doesn't mean that we're going to have that. And that's why we gave you the full sample size from the worst one that only lasted 7 days to this one that lasted 301 days. So this is what you always have in mind of the potential. And again, even with this, it's important to go through and see those breaks of the 21 day. There are some nasty ones in there. So it's nothing goes straight up. Now let's go out a little bit further. The February 8th of 18.
You betcha. Coming right up.
And so this is when something like this happens, your market school rules would already have you out. But this is where, the circuit breaker, would kick in and you've broken through your 21 day, your 50 day in a material way. And so you would have been out before this. But what I was talking about earlier about how you don't want things to run up rapidly, go up to that top day. What was that top day up there where it hit the 7? Just do a change date back there.
Okay, 126.
So this is what you don't want to see. And this is why you want to welcome the market coming in on you a little bit, because when it's running up there like that, that's climax action on a market level basis, and like something that happened back in 2000, in March of 2000, similar type of thing. Those don't end well. And when that happens after a long run, look out below. But it doesn't mean you pull the plug right there, because that could have gone on for another 2 or 3 weeks. So that's when you're selling into strength, you're tightening up your stops, and you're looking for that exit. And fast forward, let's just go out to the end of May.
Okay.
Just so everyone can see what happened. Lots of volatility. So what had happened there is because when the market breaks like that, and just like we had that break, about a month ago, that lots of times it needs time to build itself back before it can trend again. And that's what happened here. So you always want to be flexible, that there at the top, when it hit the 76 and change, 7,600 and change, everything was looking good, but you had that major downside reversal. And then you really knew that there was a character change on that gap down through the 21 day. So even though we're all bulled up right now and everything looks great, power trend starting on Monday, nothing could go wrong. Things can always go wrong. You always want to have an exit strategy. So again, this weekend, what you're going to do, besides going through this, your homework assignment. Now let's go to the current day, just so people can kind of refresh their memory of where we're at. So we're at what looks like the beginning of something. And let's look at the cues just for a second.
Sure.
So with this, I just like it just because it's got the little flat base on there. And you can see that it broke out of something. So when something breaks out of a base, you expect it to move higher. So if we break down and come down and hit that 21 day, then your game plan changes from being aggressive to being conservative and protecting capital. So again, there's a time and a place for everything. Let's toggle back to SPY because that's what everyone looks at. And now, so have SPY in your mind for a second because this is market cap weighted. Now let's toggle to the RSP. That's the equal weight of SPY. And so it has a little bit more to go. So that's telling you your average stock is trending above its 21 day, but it's still not as strong as your mega caps. So we're going to be looking at this RSP. That's my way of looking at breadth. Look at QQEW, which is QQEW.
Yeah, my keyboard is having issues.
Well, I'm glad I'm not the only one.
Yeah, I'm just, trying to make you feel better.
I appreciate that. You always do a good job with that. And so this one is building its cup, and this is the cues that we looked at, but instead of market cap weighted, so meaning Microsoft and Apple and Nvidia way more than others, this is just all 100 of those equally weighted. Again, it's trending up, but it's still not above our old highs. So that's something we want to look for and something that will help us have even more conviction. And one last one, let's pull up the NASDAQ composite. And this is a poster child for why I do not use volume. So I did a podcast with the Saint and Mr. Smiles, otherwise known as Justin and Arusha, that you can check out on our YouTube page. What's the easiest way to get to that, Hallie?
YouTube.com/investorsbusinessdaily, or you can find a bunch of YouTube links that we tweet out all the time.
Perfect. And so I talk about why I've stopped using volume in any way, shape, or form. When I put on my IBD hat, and we talk about market stuff, because there's a team of us who decide whether to go from 20 to 40% to 40 to 60 and so on. And so a big part of that team is Ali, of course, and then you've got Chris, and you got Hatman, Justin, Ken, Mike Larkin, and others, and we all collectively look at things. And when I put that hat on, I have to look at volume because IBD still uses volume. I personally don't use it, just telling you the way it is. And this is a great example of why. And I've tweeted some things out this week of all of that volume came from penny stocks that were trading, like 1 billion shares on a 6-cent stock or a 10-cent stock.
Right.
That's just silly. Don't interpret that. That's just crazy. And so that's why we were using the follow through day in spirit, meaning it moved up enough without having that volume behind it. And we had several of them. And then, of course, this week we had our normal follow through day there. And I think there was another one in there. Yeah, exactly. So you had 3 follow through days in spirit before we had this real one. And so again, collectively as a team with Ali and everyone, that what we did is we said, hey, look, we've got this follow through day in spirit. Markets, regaining its 21 day, capped up above its 50. We had to start gradually increasing our exposure. And then this week, we went up to our max of 80 to 100%.
We sure did. So we'll have to see what next week brings. Just because we raised it doesn't mean it'll stay there. You never know.
Exactly. One day at a time.
Yep. Exactly. All right. Well, let's just give some quick final thoughts here. Heading into the weekend, we've got our homework, we've got our stock lists prepared. But what would you say? Let's just do a quick best case scenario game plan, worst case scenario game plan as we wrap.
Okay, so what I would suggest is do a lot of homework. Start with the growth 250, go through all of those, and you can build extra screens. I might tweet out a screen, but if I don't get around to it, look at the entire growth 250. Look at all of your holdings before you do anything else. Look at your holdings, put stops in there, mental stops or real stops. I prefer real stops, meaning if the stock that you're in or ETF that you're in, if it comes down to this level, you're going to sell it. No questions asked. Doesn't matter. You're not going to say, oh, but Nvidia comes out tomorrow, or but this is going to happen. You sell it. Have those lines in there. That's the most important. Then now we're playing offense. So now you're looking at your portfolio and saying, well, how much chip exposure do you have? If you have too much going into those Nvidia numbers, maybe dial it back. You can always add those back because that's a big risk and event. Now, if you have an amount that you're comfortable with, I would be looking for, until Nvidia comes out, I'd be looking for other areas. I'd look for retail, restaurants have been hot. I would look at software. I would look at gold-related, commodity-related stocks, even infrastructure plays, even though they got hit a little bit this week. Look for other areas that you want exposure to, and just have a game plan for if the market reacts negatively to Nvidia. You need to rate each one of your stocks ahead of time. Don't wait until something happens and the market breaks and then rate. You want to rate them now. So you want to keep your A stocks till the very end. You would start off sell your C stocks, then your B stocks, and you want to keep your A stocks for the last part. And I will say that starting next week, on Tuesday, every Tuesday, Justin and I are going to be doing, what are we going to be doing, Allie?
We've got Swing Trader status update every Tuesday, 5 p.m. Eastern, live on YouTube.
Yes, so. And I will try to not have any user errors and mess that up. But the point of that, it's free to everyone. We want everyone to sign up to Swing Trader. I'm taking Swing Trader very seriously. It's a team effort with Justin, Dominic, and Chris Gessel, both Gessels there, Dominic Gessel and Chris Gessel. Great father-son team, quality people, all four of us. Even myself are, I'm kind of decent, but they're excellent people. And so we do this together, and we're making lots of changes now that I've come back. And I knew there was confusing people. They're like, why are they putting this on, taking it off? Why is their exposure 100% now? And so we're going to walk through every week on Tuesday, kind of what we're doing. But to get the alerts in real time, to really benefit from Swing Trader, you've got to subscribe. It is a paid thing. I think it's very cheap. It's way too cheap. I would charge a lot more for it. I don't get a dime for it if you subscribe. So I'm just telling you the way it is. I'm not trying to make more money for myself. I want to help you, not me. I want to help you. And so this weekly thing we're going to do, we're going to walk through, kind of tell you where we're at, but to know everything we're doing, sign up for Swing Trader. And it's going to be just a great product for learning and you getting ideas. Don't feel like you have to follow every last thing that we do.
And I think starting next week actually is a really great time because it is NVIDIA earnings week. So either which way, whatever happens, I feel like it's going to be pretty active.
Oh yeah, it'll be active and we're very active. I wanted to change the name from Swing Trader to Active Trader, but since we just changed Market Smith to Market Surge, which is much better in my opinion. I love Market Surge. That we didn't want to do two name changes and confuse everyone. So it's really active trading. So when you take the product, which who should take the product?
Everyone,
and your brother and your sister and certainly your dogs should sign up for it. That there's a lot of alerts. Just be prepared. You don't have to do every last thing we're doing. Use it as an education, and it's very active.
Yeah. Okay. Believe it or not, we still have two more things we briefly want
Cool.
to talk about. And that is our lovely live audience. Thank you all so much for joining us. So like I did last week, I'm going to give a couple of shout outs. And then I have one more thing after that too. So thanks for joining us. Just asking Jerry Garcia. Do you know about Peloton, Webby? How
No, I've never used
so the
Peloton.
instructors, it's like a thing. They'll give shout outs to the people in the class. So it's what
Oh, when I
yeah.
used to watch Jackie Green would do a live thing. Jackie Green, I'm such a big fan of his. He would do this live thing, and anyways, he would shout out to everyone, and so it was
Yeah.
always
So
fun. So
we've
I
got,
love that Jerry Garcia is back. Can we get a Bob Weir, a John
I
Mayer?
know, right? We've got Emmanuel, we've got Pablo, we've got BD, just asking Benjamin. Let's see who we've got. A girl trader in there. Lots of people. Yeah.
I
Mr.
will be
Two
happy when
Virgin,
Marcus
Jeff
King and
H.
Wolfgang Van Halen are watching live.
Yeah, they might. You never know. Journey Life, Boston Trader, good stuff. Okay, so now this is
Thank you guys for all
yeah,
those.
thank
I
you
was joking
for
around.
holding on.
Thank you so much for
Daniel,
watching
thank
live,
you,
and
Don,
I apologize for messing up at the
Charlie.
beginning of the show.
It's okay. So this is the one last thing. This was my idea that I had. So if this is the live chat, but if you comment on the YouTube video in the normal comment section, we're going to randomly select one person next week to whatever your ticker request is. Don't let us know if it's in your portfolio because we can't provide any individualized investment advice. So that'll disqualify you if you tell us, oh, I'm loaded up in XYZ. But if you give us a ticker or a company that you are interested in, maybe it's a watch list stock, we're going to randomly select one of those and we're going to have Webby analyze it next week. So,
I thought we were going to give swag out. That's why I was holding up the thing.
oh,
Maybe I want to send swag. I love swag. Now, tell everyone what you found. That we do have a swag shop.
we do have a swag shop. Yeah. So we'll put the link to that in the description as well. So I actually I didn't go, hey, I want some free hats. I bought 4 IBD hats last night. I bought 2 IBD live hats and 2 IBD hats. You know, Father's Day is coming up. So, you know, I'm going to give my dad some hats and I want to rep IBD as well. So I bought some hats and we will put the link to the swag shop in the description to the video and we'll share it out. There's an umbrella. There's 2 different coffee mugs to choose from, 2 water bottles to choose
I use
from.
both water bottles all the time. In fact, if you see me around town here in Austin, I most likely have one of those water bottles with me. So if you see me, come up and say hi.
Yeah, perfect. Sounds good. So yes, the comments section is going to come out after the live stream ends. So yeah, maybe go away for a few minutes and then refresh, and then you should see that comment section pop up, and that's where I'll add some stuff in the description too. Okay, everyone, longest episode yet of our Friday SMT, but a lot to go over this week. So with that, we'll see you back here next week, everyone. Thanks so much.